Hey everybody, Preston Brent here with our Trader User Group, a weekly roundup. This is for the trading week ending January 26, 28, 20, what is it, 2018? We've had a whole year's worth of activity in the first 3.5 weeks of 2018. So I hear there's a bull market in gambling, speculating, recreational drugs, and technologies um, that are designed to basically circumvent banks and regulators. These are certainly captivating times, everybody. We have set many records as we kicked off 2018. We've seen investors add the most money on record to equity funds as of last week, as earnings seasons are kicking off and now we're in full swing. All top line and bottom line numbers are beating by records on a percentage basis. And this rush to riskier assets is just really pushing these markets higher. You can see here that there is absolutely zero, and I mean zero, divergences in our MACD. And, from the opening, the minute those gates opened, we've gone from 2675 up to highs today of 2876 in less than 4 weeks. We're setting records, folks. You can see here, and I don't have it on my screen, but I'm just going to show you here. You can see that channel and then the acceleration of the channel here once we got into the last week of last year, and now we've accelerated up. Whenever you see an ascension like this and then an acceleration like this, then you typically have a final blow off top, and then you go into a sideways pattern for a while. A lot of smart money is betting on we're going to go down. I'm not necessarily in that camp yet. In fact, for the entire year of 2017, I have been a buy the dip, where many of my hedge fund friends have been trying to short this market. I think they pretty much gave up as we went into Q4. And now that earnings are ripping for Q4, then I think they've clearly given up. But as I said, investors poured through January 24th, about $33 billion into stocks. The only area that it didn't extend, this euphoria, didn't go into high yield funds. They saw about a 2.5 billion outflow into higher yield debt. And it's telling me that we've got to get ready for a potential sideways to pullback. We're seeing some interest. I'm seeing some interesting data also in the volatility markets, the front month and back month vol futures. So this just says that while we're still in a buy the dip mode, generally when we get participation by the retail trader, or as I like to call them, rat brain traders, then we got to be very careful, because they tend to be the last to the party. Okay, now we're continuing to see money flow into the U.S. equity markets, really big time. We've got global growth. We got our GDP number, our first pass GDP number early this morning. Initially, it sold off, but then when people read behind the covers of the GDP, even though it came in first pass at 2.6%, I think that's ripe for revisions upward. But underneath, we've shown that consumer spending, which is really the main engine of GDP, rose 3.8%. I mean, that's the biggest increase in almost 2 years. And consumer spending is 70% of the GDP. So what caused GDP to not break 3%? And a lot of that was the trade deficit. We saw that it continues to be a problem with the U.S. And when we do have a trade deficit like that, or a bigger trade deficit, that tends to suppress GDP. So Trump has got his marching orders. We did see inflation, the PCE price index, come in at a 2.8% annual clip. All right, and we've just got to watch this. Now we've got the Fed meeting next week. The last 2 days, Tuesday and then Wednesday, they come out. That'll be Janet Yellen's last official business as the Fed chair, and then starting in February, we get Power Ranger Powell taking over. But right now, the markets are on fire. I can go through every index and show you. The only one that seems to be really not participating in all these highs in the near term is the Russell. You can see the Russell just barely off the highs, right? I mean, if I come into a 2-hour chart here, you'll see the Russell futures, they peaked back on the 24th, and then it's just been in a sideways pattern. If we come back to the E-mini S&P 500 futures, you can see that they just zipped right on up today. Very strong. And then, of course, if we look at the Dow was up 213 points today. We finished on the high note on the Dow futures. And then, of course, if we look at NASDAQ and see where NASDAQ finished, it did the same thing. It was up 100 points today. The NASDAQ futures finished on a high point as well. Very strong. If I come back out to the daily chart and I look at the tracking index for China, right, which is Asher, you'll see here again, 2017, or this should be 2018 highs right here. I got to change it, but these are 2018 highs for Asher. We have been on fire. Look at the All World Index, brought to you by Vanguard. Same thing. It should say 2018. I haven't even had a chance to change it. It's been moving so fast. But you can see here where we kicked off the year. This is the global index. So this tells me that money is just going all into equities all over the globe right now. The G4 is on fire, and we're rocking to the upside. This is typical. As I said before, when you get into a situation here where you've got a market that you've got a situation where the market kind of goes along, right? And then you've got a glide path for that market at that rate there. And then it breaks out and then it accelerates up for a little bit. So now you've got a steeper glide path like that. And then it breaks out and then it has the final glide path like this. It's the last hurrah. And then you go into a sideways pattern. This sideways pattern is going to be a consolidation phase. And then the big issue on that consolidation phase is that and then we're going to break and come down and form a lower consolidation phase, or are we going to break higher? So what can cause the markets to break higher and drive these PE ratios even higher than they are now? Right now, we're seeing PE ratios expand based on earnings expansion, not PE expansion. Almost the over 80% of every company that's already stepped up to the earnings confessional for Q4 here over the past couple of weeks have increased their revenue forward guidance. So that is a PE expansion, and that's what's continuing to drive this accelerated move higher. But as you guys know, especially you old pros that have been out there for a while, this can't continue. We're going to go into a consolidation pattern. And then the only thing I think that is going to break us out to the upside, we're going to need additional news. Now, that news could be a number of things that Trump's administration's working on. One is infrastructure spending. That is going to put an upward can here, because it's going to stimulate the economy. It's going to bring more new jobs in the middle of the sector. Consumer spending will also do it. And if he gets a throttle on some of the trade deficit, that will also do it with GDP. But by the same token, while that's there underneath, you got the Feds, all right? And the Feds are on track for hiking the rates 3 times this year, right? The markets have priced in about 2. So anything that the Feds say next week that could indicate a little bit more of a hawkish stance, that will send the markets down. Not in a tailspin, just another consolidation zone, just a little bit lower, and then we will sit there until we're getting more news out as to whether we go higher again or lower. It's not going to be a free fall like some people like to think. I do believe we're going to get that free fall, but we're nowhere near there just yet. We've got earnings are very strong. We got strong global growth. We even had durable goods come in. They accelerated to 2.9% in December, and it showed higher demand for big ticket items like airplanes and some autos. So it's just a very strong month, a strong start to the year. Okay. So there's really no other way to couch this. Now, the one thing I will say, the mid cap, S&P mid cap, you can see here where we started to enter a consolidation phase a few days earlier, just like the Russell. Now, you would expect if the markets were on fire like this with these tax packages and these tax cuts, it would benefit the small cap and mid cap the best. But they're in a holding pattern. Again, if I come into a 2-hour chart, you'll be able to see this, right? They're in a 2-hour or in this 2-hour chart. They've been on hold here, not like the rest of the indexes. And you would expect them to be exploding higher, but they're not, okay? Now, we've seen some sector rotation as well, which I'll show you in just 1 minute. If we look at volatility, let's look at VIX, okay? The VIX is at 1110. It is still very low. We're chopping around in what I call the green zone. I've got different zones here that differentiate certain strategies that we do. Zone 1, it's generally below 15 in a VIX. Zone 2 is less than 22, between 15 and 22. Zone 3 is 22 to 31. Zone 4 is over 31 to 50, and then what I call my black swan if the VIX gets over 50. These are surprises. The last time we hit a black swan was in 2015, and the VIX went up to 53.29. In 07 and 08, going into 09 and the debacle that we had back then, the VIX actually went up into the 90s, I believe. So it just shows you that we're extremely complacent in the market. And we've been down here for quite some time. I mean, if you look at this, really not till going back to 2016 have we really seen any volatility in the market. It just can't hold itself. We will get volatility back into the market. We will get back into zone 2 and possibly, I think, zone 3 for this year. It's just not ready for it just yet. Okay, we're not ready for it. Look at the bond market. Bond market's fascinating to me. You can see here how we've been going down. We're in our secret trader. By the way, for those of you that are not in our secret trader, I highly encourage you to come in and join. We're kicking butt in the oil markets. We put on some bond trades now. We've just put on some new trades in SPX. And we're just kicking these off. Oil we've been playing for the past year. We're 23 for 23, and I don't think that's going to change. So check us out in the Secret Trader. Just join our group, and you'll be able to partake in it. Look at the bond market. We've started down back in right after the Thanksgiving holiday here in the U.S. markets around November 28th. We hit a peak of 154, and then we're just following this regression channel down. The width of the regression channel measures the volatility of this down movement. It's on a 0.876 factor here, so it's a little bit wider than I would like, which means we do get elevated up. But I had projected the bond market would come down to about 147, and I was projecting that back in December of last year when the bond market was up here around 154, 153 area. That's exactly where we're going right now. There is no bullish divergence here. Any rally in the bond market right now, any attempt at any kind of rally here is probably got to be sold off. I expect interest rates to finally start making their move this year. Last year they didn't. Everybody was trying to play the dollar to the upside. And guess what happened, folks? The dollar crashed. And there are a number of reasons for it. I've spent a lot of time with our members explaining what's going on with the dollar. And it's one of those things where you just have to understand it. If we look at the interest rates, look at the 10-year interest rates. We finally broke out of that downsloping channel there. Okay. And the MACDs tell me that any dip here is going to be bought and it's going to go higher. What does that mean? That means higher interest rates. If I put this on a weekly chart, I'll show you what I'm talking about here. It's the 10-year interest rates. And if we just really go back in time, and I mean way back in time, all right, it's a weekly chart here. Let me put it on a monthly. That may be a little bit cleaner for you because we're going way back in time. All right. It's a monthly chart. And you can see here, and this is as far back as I can go, but it goes all the way back to 1982. This is 1994 when interest rates on the 10-year were 8.1%, but they were up a lot higher than that. They were up about 18%. All right, really. But look at that trend line. This is the glide path that we've been on since the middle 90s. This is now, we're now breaking out of it. If I blow this up here, you can see here that we're slowly getting these positive divergences in the MACD. All right, now this is a monthly chart, so it's going to take some time to play off here. Okay, and you can see that low there, and we made a lower low there, which gives us a valid what we call BUD on the MACD, bullish divergence. And now you can see we finally broke out on this chart right here. That is another key level right there that I'm going to be watching for. All right, real key level for us. So these are things that are telling me that, hey, you want to be short bonds, you want to be long interest rates. So if we come in, and let me just take some of these off the screen because I got a lot on here, and it's just, I mean, this is a monthly chart, so you don't really trade a monthly chart, but it really gives you a good macro view of where we're going to go. All right, so let's take it back into a daily again, and let's really zoom in a little bit. Okay, so there we are. We've taken off. And then I would say, where to next, Sherlock? Well, if you look at this, we've got an area right here that represents a resistance zone, and we're attempting to break out of it right now. And if we step it back even more, we've got let me just take this off the screen, but we've got another resistance zone that is just as powerful right there, that's a little bit wider. This is the one that I'm watching that's going to change the dynamics of the equity market right there. Right around that 3% area, but in this zone right here. If we clear this hurdle, interest rates are going to slowly wind their way up here, probably chop around here. But if we break that, that is going to be the camel that pretty much breaks the back of the equity market, and you're going to see a change in dynamics and change in sentiment. For our members, I'll go into more detail on that. Now, I do know that Goss, who's kind of like known as the bond king, viewed if the 10-year gets over 2.5%. I've never been a believer in the 2.5% number. We've been over the 2.5% number going all the way back to the first week of January. Okay, mine is more the 3% level. All right, now granted, we're sitting at 2.66%, so we're looking at about another 30 basis points. 32 basis points, 33 basis points to get us up to 3%. And notice the wide area here that can serve as resistance. What I suspect is going to happen is interest rates, once they've cleared this key pivot point right here, it's going to bounce around here, and then it's going to wait for the Fed. All right, this is a daily chart, so we're going to get a good idea with the Feds. If they come in a little bit dovish, you'll see it come down a little bit, but it's not going to go too far because the markets believe that inflation is going to start taking hold, especially if the consumers are spending like they're spending, and that's going to jack it back up again, and then it's going to force the Fed's hands. And if they come out more hawkish, folks, we're going to be up there very quickly. All right, I mean, you can see here we move from 240 basis points, which is 2.4%, all the way up here to 2.7%, 270 basis points. That's the 30 basis point move, right? That's the 30 basis point move, and we did it in the past 3.5 weeks as we went into January. 3.5 weeks, 30 basis points. We're sitting at about 266, so another 30 basis points puts us at that mythical area there of around 3%, which is in this zone right here. So don't tell me it can't happen. It can, and the Feds can speed it up, and that'll change some of the sentiment in the markets. For our members, I'll spend more detail on what that really means and how we may want to play it. Currency-wise, the dollar has gone below where I thought it would go. If we look at the dollar index, right here, it just is ugly. Look at that. The dollar has been going down. This channel is really, the high point of this channel was January the 2nd, 2017, and it's done just the opposite of what everybody thought. And then you can see the rate of acceleration right in this area right here. It just accelerated the speed. It's going to be like a blow off bottom, but we absolutely have no divergences on here at all. That suggests to me that any move higher right here, it's probably going to be sold off, and we're going to have this long basing pattern, and then it's got to determine where it's going to go. All right. The feds can push it up a lot, but just don't be too sure of it. And what this has done with this downward momentum in the US dollar has really driven up commodities such as gold, oil, silver, metals, all of these things, industrial metals, anything that is uh, uh, um, trades in dollars internationally has been very bullish, right? Because most of these things, a weaker dollar means these things are less costly. Uh, and if we look at the euro, I mean, the euro has been on fire and they're in a pickle. Look at this thing. The euro is like, looks like the equity markets. Okay. I mean, just blew right through my resistance point, and we're sitting at 1.25. Unbelievable. The euro was down at 115 at the beginning of November, and it's moved 10 cents in less than 2 months. Unbelievable move, folks. And you can see there's no divergences in here either. All of this is what's driving the dollar lower. And Super Mario is going to have a tough time because this is going to slow down the European markets. Things are going to get more expensive over there. And that's going to continue to push some money back into the U.S. markets, especially in our treasuries. If we look at gold, guys. It had a little bit of a down move today, but that's to be expected. Look at the channel, the upward move here, where we hit. We're nearing a high that we haven't seen since 2016, but we're still bullish. I don't see any divergences here at all. So any dip is going to move us back up into the mythical wide zone here that really starts around where we are now, taking us all the way up to 1430. Silver's the same thing. They both pull back a little bit today, but look at it. You know, silver is a little bit weaker than gold, but fairly strong, right? And if you look at the gold miners, they are not showing the strength that gold is. They're not showing the strength that it should. So they'll play catch up. I think they will kind of come on. And then if you look at this 3x gold bull nugget, it still doesn't show the strength. So we've got to be really careful. I still haven't entered into a long position in gold, although it's moved up. I said at the beginning of the year, gold will be higher than where it started in the year. So now it's just a matter of playing it. If we look at oil, our buddy oil, 66.24. We're near the 2018 highs, 66.66, kind of an ominous number, I guess. But that's where we are. We started 2018 at 60.20, so we've moved $6 and about 38 cents, something like that, 34 cents, a little over $6 in less than 3.5 weeks per barrel. That's a strong run. There's really very little to the way of divergences on here. If we look at the 2-hour chart, we take it in just a little bit. You can see we're going to set up for a little bit of a pullback. I believe we're going to get a pullback in the dollar. In oil. If I just project where it can go, I think it'll probably break the 67 barrier early next week. Then we'll enter a sideways pattern. We'll see where the inventory levels stand with the API, American Petroleum Institute, and then we'll get the Energy Association Index, the EAI, and we'll get our EIA. We'll get that. And I believe oil is going to be really good for our trade and what we're doing with the oil market. So I see a lot of opportunity there. Also, gasoline. Gasoline is moving up to my target area, as I said it would, right? Look at this. Here we go. There's gas right there. If you guys remember from our last session, I had a regression channel in here, right? Let me blow it up so that you guys can see it. And what I said here was when we break this regression channel, we're going right up to this area here, and that's exactly what we've done. It's a classic 3-4-5 pattern. Break the regression channel, and here we go. Now we're going to do kind of an ABC pattern here, go a little bit sideways for a bit, and kind of determine where we want to be. We traded this pattern last year, made money on it, and I'm going to stand down right now. I do not want to chase it at this level, but I think February, March, and April traditionally, seasonally, are very strong for gasoline. Very strong. And what we've got left is agriculture, meats, and softs, some of them very strong. There's going to be some trade opportunities for us there as well. So, folks, I just wanted to come in and give you guys a synopsis at a high level of where we are, where we're going. Now, for our members this Sunday night, we're going to be going into more detail on these things, as well as our oil trades and some of the trades that we just put on in the SPX. For our option masters, folks, if you're not in our option masters program, it's probably going to be over 200 hours of video on that. I highly encourage you to check that out as well. That's going to be coming up next Thursday evening. All right, everybody, have a great weekend. I'm going to get my, you know what, out of the cold weather here in the New England area. I got my office up here in Connecticut, right outside of New York. And I'm going back to my office down in Boca Raton, Florida, where the weather is much more conducive for me. Anyway, have a great weekend, everybody. Members, I will see you this Sunday night, and let's have some fun. Talk to you guys later. Ciao now.